Hey guys, welcome back to another daily update video. It is Tuesday, June 30th. The market's been closed about an hour now. It's 5:09 p.m. And today was not only the last day of the month, but it was also the last day of the quarter. So quarter two of 2020 is in the books. And just as another heads up, I'll give you another reminder that at the end of, I believe, next month, July, is when the second quarter GDP numbers are going to come out. So obviously everyone is expecting that to be a negative number. And since we already had a negative number in quarter one of this year, that would confirm, because we would have two consecutive negative GDP quarters, that we are in a recession. So obviously that's probably going to be priced in to some extent in terms of the stock market. But I think if the GDP numbers are worse than we're already expecting them to be, then I think that's incentive, or that's a sign that the stock market could go even lower, create a little bit more fear again in the market. But just a heads up, in case you have options expiring towards the end of the month, or if you're going to open up new positions towards the end of the month, just keep that in the back of your mind, because that may swing stocks down. But also, if the GDP numbers are not as bad as we think they're going to be, then maybe stocks will go up on good news. So again, I think it's going to be similar to an earnings play, meaning you might have wild swings whether up or down. So just an FYI and just a heads up. So looking at the heat map today, we can see a lot of green on the board. I think just as much green, if not maybe even more green compared to yesterday. I mean, look at big tech. Amazon was up almost 3%, Facebook up 3%. So Facebook's kind of rallied since the end of last week when they had all that bad news break about all these companies pulling their advertising from the platform. So if you got in shares, or if you had some catch secured puts on Facebook, you're looking pretty good right now. And remember, this is a short week because Friday is the holiday. So the market is going to stop trading on Thursday. So there's only 4 days this week of market trading, just another heads up. But I mean, look at semiconductors. Semiconductors, I think, rallied hard off Micron's earnings yesterday. I mean, look, AMD was up 4.6, Qualcomm 2.5, Micron up 4.8, 3.2 for NVIDIA, 2.7 for Intel. So semiconductor sector really rocketed up, and I think that's all piggybacking off Micron's kind of win or good earnings yesterday. So kind of regretting not having some positions right now in semiconductors, but what are you going to do next time? So let's take a quick look at Disney. So if you remember from my video yesterday, I actually sold a strangle on Disney. And so by that, I mean I sold a put and I sold a call that are both expiring this Thursday. And so I'm playing Disney to both the upside and the downside. Now, a few of you are very astute because you know that I tend to be very conservative and very safe in my plays. And so I sold a put on Disney at the $100 strike price, and I sold a call at the $115 strike price. So we'll get into that in a second, but let's just take a look at what Disney did today. So a part of the reason why I made this trade is because this is what I thought Disney would do. I thought Disney would either trade sideways for this week or go down even further, even lower. But I predominantly thought that Disney was going to trade sideways. And in doing that, I just wanted time to eat away at my premiums so I could have theta decay or time work in my favor, and I can just collect premiums by the stock not doing anything and just trading sideways for the whole week. So that was my hypothesis, or that was my working thesis. So that's why I made the strangle play. Because with a strangle, when you pick your strikes for the put and the call side, you want the stock to trade and end the contracts or expire in between those two price ranges. So my price range is from $100 for my put to $115 for my call. So by end of day Thursday, I need Disney to stay between $100 and $115. And when I opened this trade up yesterday, Disney was around 109, 110. And as you can see today, it went up and down, was in the green for a little bit, red, green, red, traded sideways, then rallied hard during power hour. It quite literally ended up at the same place where it started. I mean, we opened the market at 111.68 and we closed at 111.51. So we are literally 17 cents of movement from market open to market close on Disney, which is exactly what I thought it was going to do, because it did something similar yesterday. I thought it was going to trade sideways today, and I'm hoping again that it trades sideways Thursday and Friday. But as you can see, I left a bigger buffer on the downside because I left a $10 buffer between my strike of 100 and the current share price of 111. So let's take a look at the options chain here. And I did that for a reason. So when I sold my put, I wanted to leave a longer buffer on the downside because I thought that only bad news or no news was going to happen for Disney this week. Because the news that the theme parks were going to be delayed already broke last week, which is what sent the price coming down. So that was already factored in at some point. So I thought either, maybe Disney will go down by another $1 or $2, but I don't think it was just going to plummet down, right? Because it's not the end of the world for Disney, because they have other streams of income such as DraftKings stock. They have Disney Plus, obviously, and then also now ESPN, right? So there were also rumors now of the NBA maybe not starting their games up, or certain NBA players are not wanting to play. So again, just more potential bad news that could come out for Disney. So that's why I wanted to have a longer or a bigger buffer on the downside for Disney. That's why I have a $100 strike. So admittedly, I didn't collect a lot of premium because it was so far out of the money. I actually collected $19 in premium. But you can see in 2 days now, I've already made $16. That option now is selling for $3. So I could close this position if I wanted to, and I've already made $16 out of my max $19. So just to calculate a quick, profit, I've already made 84% profit on that leg of my strangle. Now, on the upside, when I sold my call, I was a little bit risky. And I was risky for a couple reasons. I was risky because I was not as deep on the call side, meaning I was only about 5 strikes away from at the money. So because of that, I collected more premium. I actually collected $50 in premium. And you can see it's right now already trading at $22. So even though Disney's traded sideways for 2 days now, I'm already over 50% profitable on this option. So if I wanted to, and I don't want to gamble in terms of that strike being tested, because maybe Disney wants to rally tomorrow and Thursday, I can just close this position out, buy this option back. I will have made $28 in profit, and then I could let the put side just expire and get max profit on the put side. But I'm not going to do that because I'm going to get a little greedy here. Because I think my hypothesis still is that Disney is going to trade sideways or maybe go down a buck or two the next 2 days. And again, because all the bad news has already come out for Disney, there's no potential good news on the horizon. So that's why also I was closer on the call side, because I didn't think there was a big chance that Disney was going to rally $5 in 4 days, because there's no potential good news to break for Disney. Because also the cases of the illness that are going around are rising in Florida as well. So it was only potential more bad news for Disney or no news. So that was the reason why I opened this strangle. Now, some people have commented in my previous video that aren't I selling a naked call because I don't own any shares of Disney. If I owned 100 shares of Disney, then this would be a covered call on the call side and a cash secured put on the put side. So that would be 100% covered strangle, which is true. But like I said, I don't own any shares of Disney. So it's true that I have a naked call on the call side, meaning I have no shares to back it up, but I do have a cash secured put on the put side. So how would you want to manage that naked call? Or what are the risks? Let's start with what are the risks of the naked call. The risks are, if end of day Thursday, Disney is at $115 or higher, that means that I have to buy 100 shares of Disney at $115 each. So that means I have to spend $11,500 and buy 100 shares of Disney and then give it to somebody else. So I would essentially lose $11,500 on Disney if Disney closes the day above or equal to $115 end of day Thursday, because it's a short trading week. So that is very risky. And you might be asking yourself, well, he's such a conservative trader. Why in the world did he make that play? I made this play because I already have a plan if Disney starts rallying. And you have a couple options. So your options could be just close out this position, meaning let's say I'm happy with my gains. I don't want to risk 2 more days of a potential Disney rally. I can just buy back this call. So I would just buy the call for $22, close out my position, and then I'd only be left with a cash secured put on Disney. And I could just take my profits and run, which is perfectly fine. There's nothing wrong with that. The other option would be, let's say Disney goes to 113 tomorrow, and I'm getting a little nervous because it's getting awfully close to 115. What I can do, actually, let's just say the stock price is where it is right now so I can show you the actual numbers that are in Robinhood. Let's just say it's at 111, my strike is at 115, and I'm getting nervous because I said, you know what, I don't want to lose $11,500. I want to, try and get rid of this. Well, what I can do is I can roll this position out to next week. So let's say we're getting a little too close for comfort to 115. So what you can do is you can buy back your option. So I would pay $22 to buy it back. Now I get to keep the difference, right? Because I sold it at 50. I'm going to buy it back at 22. So I already get to keep my $28 in premium. So I can do that, and I can sell another call for another expiration date. So I can roll it out to, let's say, the following week. So then I would go to sell call, same strike, 115, or you can go higher or lower depending on how much premium you want to collect. But if I rolled it out to next week, you can see that I would collect $119 in premium. So what that allows me to do is basically I pay $22 to close out my position, and then I would receive $119 in premium by selling the call for the same strike for the following week. Now, for example, if let's say you did not want to sell it at 115 for the following week, you wanted to sell it at 116 or 114, that's fine because you would just collect a different amount of premium. And then obviously, whatever your premium is for the following week option that you sold, just subtract it from the price that it takes you to close out the current week's option, which in my case right now is $22, and that would be your net profit. So let's say I wanted to just roll my position out for the 115 strike for the following week. I would collect $119 for selling that option for next week, and then I would pay $22 for buying my option back this week to close it. So I would still be net positive $97. So that's one way to defend your position in case your strike is getting tested. So that was always my game plan, is that I was not going to allow myself to get exercised at 115. If the share price of Disney gets to like 114, I'll just roll out my position for the following week to give me another week's worth of time for Disney to close below 115. And like I said, if I wanted to give not only myself more time, but more of a buffer, I could roll it out to $119, right? Because I would collect $36 in premium for next week. I would have to pay $22. So I'd still be net positive $14. But now Disney has to get all the way up to 119 for me to get exercise on that option. So that's how I was planning on defending my position if it came to it. But like I said, right now, Disney's been trading sideways for the past 2 days at $111. So I'm pretty confident right now, or I'm happy with where I'm at position-wise. But like I said, maybe tomorrow if Disney rallies to 113 or 114, then I'll start considering rolling that position out. So you can roll out calls. You can do the same thing with puts. If, let's say, your puts are getting tested, but you don't want to get assigned 100 shares of stock, you can roll that out to the following week and then lower or increase your strike price or keep it the same if you'd like to give yourself more time for the option or the trade to work out in your favor. Now, I will give you the caveat that you can roll out these options until the end of time, right? I could just do this week after week after week after week, but there's no guarantee that eventually the position or the option will work out in your favor. And you can see that if I did roll out my option, I would collect, in my scenario, 119 minus 22, which was $97. But you have to keep in mind now that that is $97 of profit for 2 weeks worth of option trading, right? Because this week was essentially a wash, quote unquote wash, and then I'm rolling it out to next week. And between buying back my option and selling next week's option, I'm up $97 on that leg of the trade. So that means divided by 2 weeks, for example, that means I only made about $48.50 per week. So any profit is better than zero, but obviously it's not a good return on your investment, as if the option was never tested to begin with. So it's not a great situation to be in, but there are ways to get around it and to put yourself in better positions. So let me know what you think about that strategy. Let me know if it made sense. I know a lot of people were kind of freaking out because it seemed a little aggressive, and I agree it was aggressive, but I had a plan going into it. So I think that's very important for when you make options trades, because there are really only 3 different scenarios that can happen when you trade an option. And that's the stock price goes above your strike, the strike price is below your strike, or you start getting tested, meaning it's getting close to your strike. So as long as you have a plan of what you're going to do in each of those 3 scenarios, every time you make a trade, you already have a kind of scenario and a game plan laid out, and that you don't have to kind of panic if that happens and kind of rack your brain and kind of figure out what to do. So if you go into every trade and have a game plan in place for every situation, and like I said, there's really only 3 situations to plan for, you should be set. So that was my game plan for this strangle on Disney. And so far, knock on wood, it's been working out in my favor. So let's just take a quick look at Disney's graph here. So you can see it had a pretty big rally, or pretty decent rally, actually, not big. It rallied from about 108 on June 26th to about 111 4 days later today on June 30th. So we're looking pretty good. You can see it bounced right off this Fibonacci level, and that is actually the 38.2% Fibonacci level. So right now, it's trading between the 38.2 and 50% Fibonacci levels. So it's kind of uncanny how much it just bounces right off that level. So as long as we stay in this area, you can see my strikes are 100, which is all the way down here for my put, and 115, which is up here for my call. I would have loved my call to be above, let's say 117-ish, so I can be completely out of the Fibonacci trading range, but the premiums just weren't that great. And like I said, I didn't think Disney was going to rally that hard this week, so I wanted to be a little bit more aggressive on the call side and a little bit more conservative on the put side. So I hope that answers a few questions. I know a bunch of people have commented on my last video asking. So the answer is technically yes, that I have a naked call on the call side, but I do have a cash secret put on the put side. And the one benefit of that is that, I wanted to open myself up to different strategies and different trades. And I also wanted to see, how to roll an option or how to kind of defend your position if you need to. So I thought the channel was kind of getting a little stale by trading the same stocks and just selling the same cash secret puts. So I want to be a little bit aggressive and kind of add a little bit of variety to the channel. So let me know what you think. Let me know if you've ever traded a strangle. Do you guys have any position on Disney open right now, and how are you doing with them? If we just take a look at my semiconductor stocks, they just rallied. Here's AMD, just took a big pump off Micron's earnings yesterday. Of course, Micron, look at this big rally. That's crazy, right? We even closed the day at 51.56, up from 48, so almost $3 in less than 24 hours, which is craziness. Here's IWM. IWM's kind of been sideways for the past 2 days as well. You see we dipped June 26th, which was Friday. And then we opened Monday around 140, and then we closed today at 143. So it's been trading for the plus or minus $3 for the past 2 days. So something to keep an eye on. You can see in general for the past few days and weeks, it's trying to been trading in this channel between about 134 and 146. So let's just say 134 to 144. It's been kind of bouncing up and down. So maybe in the future, if I open up a put below 134, where this channel kind of has been, maybe it'll be more secure. Maybe I can secure some profits, but we'll have to take a look. IWM's been trading pretty high recently in the 140, so I'll have to keep an eye on that. Here's SMH. This is the newly found semiconductor ETF that I saw. So you can see we had a big rally again off Micron's earnings last night, and we actually closed today at 153, which is pretty darn close to its all-time highs. It looks like its all-time highs are around 154, 155. So we've been rallying pretty hard. So let's just take a quick look at some of the active options for today. So Tesla was very popular. I think Tesla hit all-time highs today. I think Tesla closed, around $1,080, which is just craziness because just a few months ago, I think Tesla was trading around $300. So if you had owned shares of Tesla just probably less than a year ago, you just 3x your money if you just had to cash out. I mean, today, look at this big pump. Today went up $70, which is 7% alone. Again, big tech, right? Apple, Facebook, AMD, Microsoft, Micron. They're always the most popular options trades lately. Here's Space. Space was really popular today. Kind of had a good pump, about 6%. I'm assuming some good news came out on Space, but I'm not aware of, but I'll have to do a little bit of research on that. So, interesting that here's Disney again. Looks like, again, it's pretty split, 41.60 or 41.59, I should say, in terms of the call put ratio, but overall a little bit more bullish in terms of the call side compared to the put side. And you can see, look, Disney, it was literally down a penny today from where it opened. It was down 0.01%. I mean, the only way it could have gotten more sideways is if it was 0.00. So here's a graph that I found that describes the number of bankruptcies that have been stacking up. And this is the fastest pace since the Great Recession in 2009. I mean, here's the slope of the graph during the Great Recession. Here's the slope that's building currently. So again, some bearish news. Here's another graph that's showing the amount of leverage that US companies are using and how much more in debt they are. And the level of them being in debt is more than it has been since 1950. I mean, we are almost 50% higher than we have been in the past 70 years. So here's an interesting graph. So this graph is showing you the number of people who report wearing masks and then practicing social distancing and advising healthy people to stay home. So this is by party affiliation. So not to make this a political channel, you can see that the Democrats are doing a much, much better job than the independents or the Republicans in terms of practicing safe lifestyle in the current climate. Again, they're better than them in terms of the mask wearing, in terms of the social distancing, and also stay at home. I mean, the stay at home, they're almost 95%, whereas the Republicans are close to 30%. So there's definitely a big gap in all three sectors of mask wearing, social distancing, and staying at home. So depending on where you lie, it doesn't matter what political party you belong to. All that matters is we keep everyone safe and we all practice the same precautions to keep the population in general. So here's another kind of similar graph. So this is describing mask usage in public based on different demographics. So you can see that out of all US adults, 36% of people report always wearing a mask, 32% sometimes, and 31% never. So it's almost an even split. You can see women wear a mask always much more often than men do, 44% compared to 29%. Again, in terms of political party, Republicans, Democrats, again, the Democrats have been wearing a mask more often than Republicans. And you can see that the more educated people are, the more likely you are to always wear a mask. So high school to college graduate to postgrad, the percent of people wearing a mask outdoors or in public increases with the higher education level. So let me know what you think. How was the trading day today? Hopefully it was good for you. It was just an overall green day. I'm trying to keep this video on the shorter side, but as always, if you have any questions or comments, leave them below. And as always, happy trading.